the audience today. Thank you very much for spending your evening here with us. My name is Justin and I'm your host for today's episode of our Ask Me Anything webinar series. So in today's episode, we're gonna find out if you can make full use of your CPF contributions for your retirement. So, as everyone knows, 37% of our hard-earned money goes into our CPF account every month. So I think a lot of us are wondering, will the 2.5% CPF interest rate be sufficient to fund our ideal retirement? And although that money might be out of sight, it shouldn't be out of mind. Yeah, so all right, I'm sure that everyone would have burning questions. May I request that you plan your questions, because we want to end our session in 1 hour, including Q&A. So please plan your questions and put them down in the Q&A function below that you can see at the bottom part. Yeah, and for the audience, we are actually live on Zoom and Facebook on our Phillip Wealth Advisory Facebook page. So I would get my colleague to put in the link to join us on Facebook Live. If you have any friends that would like to join us as well, they can stream it live there. Everything that you see here, they can see it on our Facebook Live, on our Phillip Wealth Advisory Facebook page. So before I introduce my guests tonight, we have 3 guests today. I must assure all of you here tonight that there will be no selling during tonight's webinar. This webinar is completely educational. And if you are watching us, please share with your friends who you think that would benefit from this fireside chat, where you can ask all your questions about CPF live to our very own financial specialists. Yeah, so okay, without further ado, I am very honored to introduce 3 of our financial specialists. So let's hear from them. What are the 3 secrets about CPF they tell their clients? So this evening, we have joining us today, we have Jonathan, who is a financial services director, Margaret, a financial services manager, and Frank, financial advisory consultant. So today we'll hear from them. Okay, so I'll proceed to introduce them. Ladies first. So let's start off with Margaret. Being financially trained and practicing for more than 15 years, Margaret enjoys and specializes in helping clients optimize their wealth in simple and effective ways. So Margaret, would you like to tell the audience something about yourself?
Hello, I'm Margaret here. Can you hear me? Can hear, right?
Margaret, we can hear you.
Okay, that's great. Yeah, so I see there's quite a number of participants here tonight. I think it's a good thing. So I guess y'all are interested in managing your money, not because you have nothing better to do. That's why you're logging into this Zoom. So I like people who are interested in financial management, because I feel if you want to be financially wealthy, independent, rich, you've got to be interested, you must have the passion, and you must be responsible. So if you love your money will love you. So I hope through tonight's session, you can have either one, if not many key takeaways, and you can find this session meaningful. So enjoy the night. Thank you.
I really like that, Margaret. If you love your money, my money will love you. Okay, moving on to Jonathan. Next, we have Jonathan. Jonathan, is your video on? Your video is not on. You want to turn on your video? Yeah, okay. Great.
Hi.
Okay, so Jonathan is a veteran in the financial services industry. He has over 25 years of experience, and he has been bagging numerous awards from 2016 to 2022 this year. So he currently leads a team of 10 financial advisor reps. So yeah, and what I know personally about Jonathan is his willingness to share and educate. So this, from what I know, it has always been one of his top priorities. So, okay, Jonathan, would you like to tell the audience something about yourself?
Justin, can you put it to my page?
Oh, sorry. Yeah, okay.
Hi, everybody. I've actually with Phillip Security since year 2000. So I got more than 25 years of helping clients to do retirement planning for clients. Okay, and I've on and off do a lot of seminar before COVID-19, and then do a lot of retirement webinar too. So some of you all probably have attended my webinar and seminar. Okay, what I focus on is actually to help clients to achieve multiple stream of passive income. Okay, and throughout, the main objective is to help my clients grow their wealth first, okay, and then mitigate their risk, okay, through asset allocation, And the most important objective is to help my clients to achieve a retirement lifestyle they deserve. Okay, so hope to share more later. Okay, that's all.
Okay, thanks, Jonathan. So last but not least, let's welcome Frank. So Frank has he helps his clients to grow and manage capital through securities and top performing funds. He also provides advice in financial planning. And we just had our Flying Start award night in January, and from there he has bagged 2 Rising Star awards in just one night. So yeah, something to share about the audience yourself, Frank.
Hi, thank you, Justin. Yeah, I'm Frank here. I've 4 years in the industry, 4 years of experience in this industry, almost like 2 years in PhillipCapital. So I do I do financial advisory for my clients, in terms of mainly in investment. So because of the bullish market in 2020 yeah, correct. Then I got a lot of requests, inquiries about investment. So from there on, I actually advise my client, yeah, for investment. So that's how I got the awards. Yep.
Okay,
That's
I'm sure
all
we're
from
all
me.
excited to hear more from you, Frank, during the webinar. Yeah, okay. I think that's it for the introduction of my special guest tonight. Thank you to them. So yeah, at this junction, right, let's get our audience to tuning in to do a little poll. If you're on Facebook and YouTube, you can also comment in your chat box for the answer. If you're on Zoom, just click your answer and we shall wait maybe a minute to get to know a little bit more about our audience today. I will launch the poll now. Hold on. So, okay, do you see the poll? Please feel free to select your answer. Yes. Wow. Come on, yeah, I think we are close. We have 50% of the audience who have answered already. So just a little bit more. Okay, I think the number is okay lah. I think we can tell already. So no is the majority of the answer. But for me, I wouldn't exactly say no. I don't really know much about this. So today for this fireside chat, I'm also gonna be learning a lot from our speakers here. So yeah, let me just click on that. Wait. So a lot of people say no. Okay, hold on. Okay, so that's very interesting to know. Actually, for me, I'm not quite sure. Actually, I'm going with the third answer, which is not sure. So let's find out tonight then. Now, let's start off with our first question of the evening. What are the crucial factors we should look out for when utilizing our CPF? Jordan, would you like to start?
Yes, thank you, Justin. So Justin, you're very young, so of course you are not too sure whether CPF can help you to retire alone or not with just CPF. Okay, you will get to know soon. Okay, what's the crucial factor? You know, as Singaporeans, right? Let's say at 30 years old, when you start a family, okay, normally we will normally utilize our CPF for housing as a common things to do. So when you are in 30s, so when you progress to 40s, okay, and due to career advancement and you got more disposable income, so Singaporeans tend to by then would have paid off their housing loan, or they may have upgraded to a private property. So at that juncture, they probably because of they got higher disposable income and they do have money that put in the bank, they probably may opt to use their cash to pay for the monthly installment, okay, for their housing loan instead of using CPF so that they can grow their CPF. So when they proceed to age 50, okay, in the 50, okay, so they will continue to accumulate more CPF, especially OA and SA towards that. And they may also, during this period of time, okay, in their 40 to 50, may continue to do a top up. Let's say now CPF also encourage you to top up 8,000 every year and you got tax deductible, and that will build your CPF special account. So those people who have actually a lot of CPF OA and they are in their 40s, you can transfer part of your OA to your SA to earn 4%. So these are the things that I can actually help my clients to grow their SA. Okay, grow their SA to 192, and then after that, let it compound until 55. Then from there, okay, you can do a lot of what do you call that? Create another stream of income using your SA as well as CPF Life, which later I will share with you. Okay, so yeah, this is something that I think most of the Singaporeans, or rather most of my clients, that I will advise them to do.
Okay, thanks, Jonathan. Margaret, what do you think? What are the crucial factors that we should look out for when utilizing our CPF?
Maybe something that I can think of would be more applicable to people who are buying HDB. So when people go to when they're buying the HDB board usually will arrange for 2 appointments, right? And during the first appointment, usually HDB will actually wipe off the members all of the CPF OA savings in the account, and from there he will service the loan. So starting from 0, the member will have to build up his CPF OA from there. So assuming that he does not have any income voluntarily or involuntarily, he may not have the monies to service his mortgage from there. So usually for certain cases, we do check with clients and advise them to tuck aside a portion of the CPF monies out so that they can actually utilize it for rainy days. Yeah, that's it.
Frank, you got anything to add to this question?
Yeah, to add on to what shared by Jonathan and Margaret. Yeah, there are minimum sum need to set aside like 20,000 in OA and 40,000 in SA before you can proceed with any investment. Yeah, like Margaret said also, we have to set aside some before you pay for HDB and stuff. Yeah, that's all from me.
Okay, thanks for your answers. Okay, let's move on to the next question then. We commonly hear that one of the ways to grow our retirement funds over the long term is to invest in our CPF. Should we be investing with our special account, or what are some factors that we should look out for that are, or any tips that you guys have that the speakers can provide? Yeah. Frank, you want to start with this? This time around, you want to go first?
Yep, sure. Thanks, Justin. So yeah, it's not encouraged to invest with SA special account because it gives like 4% per year. So, but if anyone who want to do it, yeah, it can be done if the intention is to do CPF shielding. So how can we do CPF shielding is we can do it before one turn 55 years old. Yeah, so the less money in SA account, I mean, then there are more money taken from CPF OA account to form a CPF RA account. And we will take note that SA account can only be invested in less riskier asset, such as bonds and fixed income fund. Yeah. Yep, that's all for me.
Jonathan, Margaret, what do you guys think?
Hi, same
You
with
agree with
Frank.
Frank?
I will also don't suggest CPF SA to be invested. Partly the reason why is that, you know, SA is paying 4% and it's risk-free, you know. So where to find 4% risk-free over here? So another area over here is that SA account also got very limited unit trust that you can invest. And even unit trust, you are investing in investment grade bond. And investment grade bond, normally their return is about 3 to 4%. Maybe now it's a bit lower. So when you compare that, and then they got risk, no, that means their capital is not guaranteed. So, you know, CPF giving you 4%, why do you want to take that kind of risk? It makes no sense at all. Okay. So of course, over here, when CPF shielding, this Frank is saying, yes, we will probably just temporarily park them in money market and that's it. Okay. And then 2-3 months later, we will transfer back. So that is only used for that. So it's very low risk. And no, I think we should not invest SA. Let it compound at 4%. And that is a very powerful returns that you can actually get. Okay, compounding at 4% and grow your CPF SA. Okay, and to create another stream of income for yourself. Okay, that's all. Margaret?
I agree with my two panelists, so maybe I'll just wrap it up. So CPF SA 4% risk-free. So even if we assume that I can do a balanced portfolio of a long-term return, let's say 6%, so client can only net 2%, but that comes with a certain level of risk. Furthermore, like what the two panelists have rightfully pointed out, the array of investment and funds out there that are allowable using CPF monies are actually very limited. So it is really not easy. Yeah, so my answer is not really, yeah, unless you really have to, yeah, or because of any particular reasons, yeah.
Okay, well noted, well noted. Thanks, Margaret. Thanks. Okay, we move on to the next question. You know, oh, this one. Okay, so as a Singaporean, you know, we often hear others say, you know, you can die in Singapore, but you cannot afford to fall sick here. You know, a part of our monthly CPF contributions go into our MediSave account. You know, could our panelists share what kind of coverage or protection can we get with our CPF MediSave? Margaret, you want to start with this question? Yeah.
Okay. Okay, to understand this, right, you must first understand what is actually provided by the government already. So unless you opt out, otherwise you'll be in by default. There's actually two schemes that is available. One is actually the government's MediShield Life. The other one is called what we call the CareShield Life or ElderShield Life. So for MediShield Life is actually a medical plan that covers B2 ward, and it is not as charged. So for every category of the benefits of the medical plan, it actually has its inner limits. So B2, there's no aircon. So obviously it has limitations. Inner limits, it is not as charged. And medical bills in Singapore is expensive. So clients can actually have do an upgrade to example A ward government or A ward government or private to increase the coverage and also to change it to as charge. So the government gives you a budget of about $600 per year per person, whereby you can do this type of enhancements. The second thing that I think clients can do the upgrade would be to their CareShield. So CareShield, if you do not know, is actually a government disability scheme that pays out about $600 per month in the event of severe disability. ElderShield only $300 to $400 for about 5 to 6 years. CareShield about $600 for whole life. So it's very little money because imagine you're severely disabled, this amount of money, you can't even employ a helper. You know, helper nowadays is quite expensive, right? So what clients can do, actually, they can actually use also a budget of $600 per year per person. You can actually do an upgrade to example to 1,500 per month. So if there's such an event of disability, CareShield will give 600, the enhancement will give 1,500. So a person will at least have $2,000 per month. So that's a bigger sum of money to tide through these difficult times. So these are the two types of insurance that I can think of people can utilize using their CPF monies. Yeah, that's all on my side.
Thank you, Margaret. Jordan, Frank, anything?
Okay, for my side, I would say that what Margaret has said is, yeah, this is the basic two things that Singaporeans, this is important for Singaporeans, and Singaporeans should take up. Okay, but what I'm going to share with you is the mindset about this MediShield and CareShield Life. Throughout my retirement planning, a lot of my clients actually ask, you know, Jonathan, what kind of shield plan should I take? You know, when they are younger, let's say at 40. Okay, so you know, last time when they just started, so I say, oh, you should take the private hospital because of your income. You are considered a middle income. So when they look at the premium, they say, no, Jonathan, I C class, what can already? Give me C class. So the thing over here is, okay, I said, you really want C class? You think that you really want C class because they are thinking that the company do cover, okay? So the company do cover them medical. So they said C class will do. So after that, I got one incident, exactly the same thing. He takes C class, and then after that, he got appendix, okay? And he went in, he directly go to Mount E. And I said, why you go Mount E? He said, my doctor is there. So when it comes to premium, naturally, all Singaporeans want the cheapest. But when it comes to things happen, then they say, okay, Mount E is what I want to go because my specialist is there. So I always have to educate my clients saying that, yes, your company do cover you, but your company cover is limited maybe to up to 50,000 per year. But shield plan will cover you up to 1 million per year for private hospital. So it is very important to make sure that you have a shield plan that is in line with your lifestyle. Then come retirement. I got some retirement clients who say that, oh, I'm in private, Jonathan, and then recently it's so expensive, no, the premium keep on going up. I want to downgrade to B2. Just take the CPF Life also, will do. So my answer to him is that, nope, you are not allowed to downgrade to B2. Okay, if you want, you can downgrade to A class 1 private government hospital from private to government. Why? Because I said, I need you to maintain your lifestyle. If I have created about 70 to 80,000 per year of income, perpetual income for you, you can afford this and you have to maintain that lifestyle. So for all my clients, I will help them to maintain the lifestyle they deserve. So I will not allow them to downgrade. Okay, and come to this what do you call it? CareShield Life. CareShield Life is actually more for bedridden. Okay, preparing for the older age, especially when you above 75 and above. During that period of time, likelihood or more likelihood, okay, we will tend to get bedridden due to fall, due to illnesses. And what we do not want to see is to be a burden to our kids. That's why it's very important for my clients, okay, to build a what do you call that, a reasonable coverage on CareShield Life. To upgrade it, as what Margaret said, 2,000, 1,500 to 2,000, or even 3,000 if you can afford it, depending on your lifestyle again. Okay, that's all. Frank, your turn.
Thank you, Jonathan, for sharing. Yeah, very interesting story from you. Yeah, to actually sum up both what two speakers have shared. So I think MediShield Life and CareShield Life are are two important insurance that you can use CPF to pay. Then of course, myself also have I have my own story of using this insurance to pay for my medical bills. I actually had a scratch on over my above the ear because I was playing tennis. Yeah,
Oh dear.
then I got a scar. At night. Then I actually went to Mount Albania, to get a plastic surgery. Yeah, so without private insurance, I think I had to fork out quite a big sum. I think 1,000 plus, for a 5-minute surgery over here. So if I don't do it, I do it the next day. So because I have private insurance, so I do it the next day, and it's all covered under insurance. Then it's fine already. There's no scar and anything. So without private insurance, then probably I may go to like government hospital to do surgery, but how it end up, I'm not sure. Yeah, but I do actually went to the government hospital nearby. Then it was a long queue. So eventually I go to Mount Albania to do a plastic surgery. Like the specialist there to serve me that's all from me.
Okay, interesting story. Well, Frank, no worries. You still look very handsome, even though if there's a cut or anything. Yeah. Okay, move on to the next question. Yeah. So for the next question, should we defer our CPF life payout from age 65 to 70? We can start receiving our CPF life monthly payouts once we hit our payout eligibility rate, the PEA. So currently the payout eligibility rate starts at 65. However, we can also choose to defer receiving our CPF life monthly payouts to any period of time between 65 and 70. Can we hear from our speakers on what are their thoughts regarding deferring payouts from age 65 to 70?
From age 65 to 70, I think CPF always put there saying that if you take from 65, let's say you have a full retirement sum, let's say 192 this year, and then at 65 you can actually take 1,005. But if you delay to 70, you can actually take about 2,000, for example. Okay, so there's a $500 difference, and a lot of my clients actually, would always ask me, Jonathan, should I delay to 70 or not from 65 now? Okay, so they say $500 per month. That's a lot of money. So I always tell my client, do not do that. Why? Let me analyze for you. If you are taking at 65, okay, and another one, okay, person A and B, B is going to take at age 70. So 65, let's say both of them will die at 90. Okay, they take their money, their CPF life until, but they will die at the same time, presumably at 90. So 65 to 90 is 25 years. So he take A will take 1,005 for 25 years, and B will take 2,000 for 20 years, because 70 to 90. Total, how much do they collect? A will total collect about 450,000 in total. Okay, and B will collect a total of 480K. And you look at it, 450 and 480, there are 30,000 premium over it, which means that you only enjoy 30,000 more by delaying from 65 to 70. But bear in mind, in terms of retirement, what is your prime retirement year? I always tell my client, your prime retirement year starts from 55 to 75. But 55 to 65, if you are still working, okay, you must start enjoying your retirement already. We call it pre-retirement. Okay, going more tour, because kids already adulthood already, so you are more like independent, and then you go and enjoy with your spouse, go for tour and all that. Okay, go for good meals, and then at 65 officially retire until 75. And these are the prime retirement years, and you are going to give up 5 years of your payout, okay, for the 65 to 70, just for the 30,000 more. It doesn't make sense. Imagine 1,500 per month, which is 18,000 per year. What can you do with $18,000 per year for 65 until 70? Is to enjoy life. Some of my clients actually, one of the couple clients use this. Husband and wife got about 15,000 because they are younger, they are older, right? They collect about 15,000. Total is 30,000. So what do? Every year they will go city hopping. They will use this 30,000 from CPF Life because they got other stream of income that I have built for them. Okay, so when they will use this 30,000 and go to city hopping for 3 cities every year, stay about 3 weeks to a month, let's say in Nagoya, in Japan, Hokkaido, in Taiwan, in New Zealand, okay, and not be a tourist, be a local there. Stay in a service apartment, and then he tell me he enjoy it, wake up at 10 o'clock, go for coffee, go for breakfast, and then buy something to cook in the afternoon. So it is a change of environment, and that is retirement. Okay, so that is how you can make use of this and do not just sacrifice the 5 years just for the $500 more. Okay, it doesn't make sense. Okay, the main thing, the main objective is to make sure that you enjoy the best retirement you can. Okay, that you deserve as early as possible. Okay, that's all.
I agree with what Jonathan say. So I have my background is in accountancy, so usually I like to analyze things from a financial perspective. So if you defer the payout from age 65 to 70, you get 7% more per year for the monthly payout. So assuming the FRS, if it is 192,000, you can actually get 1,500. So maybe average life expectancy, let's say 85. So you collect 1,500 per month from age 65 to 85. So if you have a calculator with me now, you can punch in 1,500 times 12 months times 20 years. The amount is 360,000. Okay. Now, if you defer to age 70, your payout will be 2,100 per month. But this time around, you times 12 months. And you multiply over, example, also age 85. So 70 to age 85 is 15 years. The amount will be 378K. The difference is only 18K. So in my opinion, it is also not worth it. For only 18K is immaterial. You have to wait until age 70. Then you can start withdrawing your payout. So, and maybe I would like to say something is that actually, CPF is your own monies. So it has already been deferred for 40 years. So why do you still want to defer another 5 more years? I also see no point. So yeah, that's my answer. What do you think, Frank?
Yeah, I agree with Margaret also and Jonathan. But it also depends on individual. So some like to receive payout earlier, and for some like to defer it so that they can receive more later. If want to receive earlier, then will receive less than those who receive later. Then the person who want to receive earlier have to make sure you have other passive income from investment to make up the difference. So yeah, that's all from me.
Okay, thanks. Thank you. Thanks, Margaret, and your calculator as well. So we move on to the next question. Yeah. Yes. Do we really have other options to create multiple streams of income besides depending on CPF Life for retirement? So everyone is aware of using CPF Life for retirement, but do we really have other options besides CPF Life? Yeah. Any of the speakers
Can I
like
start?
Yes, sure, Jonathan, go ahead.
Yeah, okay. I have been planning for my clients for retirement plan. I've been doing retirement planning for a lot of my clients for about 15 years for now. Okay, so what I normally would do, it will always advise my clients, okay, make sure 90% of your total asset, okay, should be invested to create retirement income stream for yourself. Okay, and besides CPF Life, okay, that I help my clients to do the shielding, right? Okay, then you got another SA income stream. So CPF can create two income streams for all my clients. Okay, so the SA and the let's say, okay, if you do, okay, when come to doing shielding, what we do is at 55, we will try to help my clients to build a CPF SA, let's say at least 192, and then OA, maybe I will tell my clients to continue to build. If let's say they can actually do a property refund, okay, to their SA, to their OA, so that they can actually have at least about 150,000. So with 150,000 and SA, you transfer out that time, whatever that you have in your SA, okay, you will be able to achieve the 192 full retirement sum. So normally, typically, what normally I can actually do is I will preserve 220,000 of SA for my clients, okay, the typical one, and then 192 for CPF, 192K for CPF life. So if you look at it at 55 until 65, the 220 will compound to 320 or 30,000 for the SA. But then the 192, every year I will still encourage my client to top up 8,000, okay, until for 10 years to build up the CPF life. So by then, my client should be able to build up a CPF life sizable enough to give at 65, give about 2,002, okay, per month. And then special account, I will encourage my client to draw out the principal. Let's say 320,000, you draw out, you should be able to draw about 13,000 every year, the 4%. There's another stream of income. So add up, my client will have about 3,004 per month when they are 65, CPF Life and CPF SA. So 3,004, and on top of that, my client will also, I will also help my client to invest in dividend portfolio, okay, in managed account, okay, and then on top of that, also some insurance, they are safer one, capital guarantee, that will pay maybe 3 to 4% of coupons. So that will create another 4 or 5 stream of income. So total, you can see that is 2 from CPF, 2 from dividend portfolio because it got cash and SRS, and then 1 from managed account, there's already 5, and then another 3 or 4 from CPF, from insurance, the safer one, capital guarantee. So total, I can easily create about 6 to 8 or even more of stream of income for my clients. Remember, I always tell my client, every pot of your money must help you to create the income for your retirement. Okay, any pot that is not creating, like CPF, a lot of my clients before meeting me, they like to put 500,000 in CPF OA, don't touch. Okay, don't touch, let it grow. Those are what money? Those are not your money. Because a lot of time, if you put in CPF, okay, if you put in 500,000 there, for 10 years, it will grow to 640. For 20 years, it's 800. For 30 years, you put there. Okay, that means 65 until 95, you die, you got 1 million. And this money you won't touch on, and you don't touch is not your money. It belongs to what? Your next of kin, your kids, okay? And as well as maybe your niece and nephew, okay? They will be very thankful. So don't do that. Whether is it SA or OA, try to create income. Okay, OA normally I will tell my client to create income, but SA you draw out the 4% to spend. Any money that you put there and give you a stream of income, it becomes your money. But we're trying to preserve whatever, maintain the principal, and spend on all the income stream that created. And that is how I help my clients to create a multiple stream of passive income for their retirement. Okay, thank you.
Okay, I will go first.
Okay,
Thanks.
great.
Yeah. Like what Jonathan has shared, I also advise my client to invest in bonds, fixed income, and also retirement plan from insurance company, and also unit trust to create more passive income. So more of my clients are around my age, around 30 plus. So actually, they have longer life, longer time frame to invest their money. So be it by using CPF OA to invest after setting aside for housing, mortgage loan and stuff, then actually is free to invest in from the money from OA. Then also they can use cash to invest. Yeah, so I advise mostly my client in unit trust, and I manage for them. Yeah, that's all for me. Margaret, your turn.
Okay. I think we talk about multiple streams of income. Of course, we do have. So you can also have your own income payout from using cash type of plans, such as savings plans, retirement, which is mentioned before. Any types of dividend based from unit trust based portfolios, shares based portfolio, managed account based portfolios, and even your own property portfolio. So definitely whatever we have from CPF will not be enough. So using cash, you will still need to build different multiple streams of income. Thank you.
Okay, so it's good to know that we really have other options to create multiple streams of income other than depending on CPF Life. Okay, now let's move on to the big question of the evening. So what secrets of CPF, about CPF, do you advise your clients that have benefited them? Please share them with us. So yeah, any of the speakers that will start first?
Oh, okay, maybe I can try.
Sure,
Okay,
Margaret.
so CPF, there are 3 accounts, right? So for our CPF MediSave accounts, I'm not sure if you know, actually there is a cap to it. So I think that is what we call the basic healthcare scheme. It's actually about 60/1,000. So once you have worked for many years, your CPF MediSave account reaches 60/1,000, it will actually stop contributing. Where does the money go? The money will actually go to your special account. Now, MediSave account 60/1,000. What is the MediSave account money supposed to do? It is supposed to take care of medical costs. However, in Singapore, medical cost is one of the highest thing, right? Like there's a saying, you cannot afford to fall sick in Singapore, but you can afford to die. So that's totally different from the COVID situation now, right? You can afford to fall ill, but you cannot afford to die. So, CPF MediSave, right, 60/1,000 is actually not enough. Okay, if anything happens, such as major illness. So just to let you know, CPF MediSave gives you an interest of 4%. So usually I tell my clients to use the interest from the MediSave account to get the best enhancements you can get. For example, if a MediSave balance is 30,000, 4% interest, if you press your calculator again, it will give you 1,002 interest per year. So without touching your balance, right, just using this pure interest, example 1,002 per year, you can actually get the best integrated shield plan. You can do the best enhancements for your cash shield, and you didn't touch your capital. If anything happens, let these 2 plans take care of you. Okay, so your balance of the monies which you didn't touch because you only utilize the interest, right? You can actually use for whatnot outpatient treatments like MRI, CT scans, which MOH do impose certain limits also. So you also cannot use it very freely anyways. So what we are doing here is that we are trying to not have too much disruptions for your CPF MediSave monies. We try to protect it so that the lesser you use, the quicker and the more you can build the access to your special account monies for your bigger retirement pots in the future. So that's a secret that I can share.
Jordan, your secret. I'm sure after all these years of experience, a lot of secrets. Yeah.
Okay. The secret over here is always to try to build up your SA as fast as possible. So the main thing is that our SA is capped at 192. So if you are young, right? Okay, if you got higher disposable income and you got CPF OA, and then you can also do a top up. So the best is when you are young, you can do top up. Let's say when you are 30, 35, even for Justin, you can do top up. Maximum is $8,000 per year. So you do a top up $8,000 per year cash, and then you can get tax deductible. So build your CPF to 192 ASAP, because the 192 in your SA will compound at 4%. And can you imagine you compound, if you build it 192 as soon as possible, let's say when you reach about 40 years old, and you compound until 65, 55, you know how big the amount is. So that is the secret that I will always advise my clients to build up their CPF SA ASAP. Another thing that you probably a lot of time people are a bit of a worry, or rather they did not really look into their affordability, is buying property, especially private property. So they did not really calculate properly their affordability, and they whack up most of your OA. Okay, so they use all their OA, and then they continue to do that. Okay, and when the market come down, okay, so they will probably have to serve with cash and all that. And if they lost their job, they probably, I do experience some of my clients who lost their job, they can't afford to pay the mortgage, and they have to sell their house. So, and they make a loss. Okay, that's in the not the near last 10 over years, but in the year 2000. Okay, so there is a difficult time there. So be mindful of what kind of loan are you, especially right now property is so expensive, and what kind of exposure you are, what kind of commitment are you getting into. Be very mindful about that, because once you have that, okay, and to build up your CPF again, you need a longer time. Okay, so you have to be very prudent in terms of utilizing your CPF for housing or for investment. Okay.
Thank you to our speakers for sharing with us their secrets about CPF that they advise their clients. Yep. Hold on. So, okay. So I think that, wow, I can see there are a lot of questions in the Q&A function. But before we move on to our Q&A section, I just want to welcome you to connect with Phillip, and also with any of our financial specialists tonight, Jonathan, Margaret, Frank. All of them, they have something in common. No, actually they have one thing in common, is that they are all active on social media, and they are always very generous in sharing and broadcasting value-added financial tips to their customers and their followers, just like how they've been doing for us tonight this evening. Yeah, and they are also growing their team, and they welcome like-minded individuals to join them. So if you'd like to reach out to them, there's a short link here and the QR codes respectively. You can feel free to connect with them, reach out to them through these links. Yeah, or you can also drop us an email at talktophillip@phillip.com.sg. And if you would like to reach to them, we can also connect with you there. So for those who are enjoying, this webinar like this one, and you would like to stay connected with us to receive more updates and for more events or webinars like this one, give us a like on our Facebook page. It's Phillip Wealth Advisory, facebook.com/Phillip Wealth Advisory, facebook.com/Phillip Wealth Advisory. Yeah. Okay, I think we should get on with the Q&A. It's getting late. So let me just go to the function and pick out some questions. Oh, there are a lot of questions. Okay, let's see. Okay. We start with the simple ones first. Okay, there's a question from Gio Lim. Can I put the minimum sum at 55 when I have more money than I top up? Anybody want to answer this question? Jordan, want to answer this question? Can I put the minimum sum at 55? Then when I have more money, I top up.
Yes, you can. So the minimum sum we are talking about is 192 full retirement sum, or are you talking about the basic retirement sum, which is half of the 192? Okay, so if you are talking about the half of the 192, then you got to pledge your house. But if you are doing a full retirement fund, full retirement sum right now this year is 192. So most of my clients will take the full retirement sum, and then anytime you want to top up before age 65, you can. Okay, even after you are 65, you can even continue to top up to enhance it. No problem at all. You can.
Okay, thank you. Another question from Lai Tak Wai, quite similar. After 55 years old, can we still transfer OA to SA?
The answer is no. Okay, once you are after 55, you can never be able to transfer OA to SA. Even before 55, SA, once you reach 192, let's say at 45, you reach 192, you can never be able to transfer OA to SA. So, but after 55, if you are still working, you contribute to your SA through income, right? Through your normal income, okay, your employer contribution and your own contribution. Yes, you will build up your SA also, but you can never be able to do any top up, okay, or do any transfer from OA.
Could we have a question from Mutu? Could we use Medisave for the top-up insurance for CareShield Life? Margaret, you want to take this question?
Yes, of course we can. So for example, just now the enhancements that I mentioned, for the CareShield enhancement, for the MediShield Life upgrade or enhancement, you can actually use your CPF Medisave monies. It's supposed to be the budget that you can use is actually $600 per year per life assured per person.
Okay.
Per plan. Yeah.
Okay. Another shielding question from Evelyn. Thank you for a question. On CPF shielding, will the SA invested be credited back to SA or RA?
I answer this?
Okay, sure.
Yeah.
Jonathan, go ahead. Yeah.
Okay, it will be credited back to SA because you are using SA shielding. You transfer SA out, okay, and then when you put back, you will go back to SA. So once you transfer SA out, you will use your OA and 40,000 from an SA because you need to hold 40,000 that can't invest out, and these two add up and will go to your RA. Once your RA is already transferred, let's say you meet the full retirement at 192, then you can actually start to transfer back your SA, those that you transfer out back to your SA again.
Okay, thank you. Okay, we have a question from Karthik. Can you share more insights on investing CPF money in bonds? How do we start this? Thank you. Thanks for a question. Would any of our speakers like to share more insights on investing CPF money in bonds, and how can someone start this?
No, okay. let me share some. If let's say you want to invest in bond, what kind of bond? Asian bond, this emerging market bond. Okay. To me, if let's say you want to invest in bonds, yes, there are some bonds that in the OA makes a set, but there are risks. So OA is giving 2.5. So it depending on what kind of risk are you willing to take. So SA is a no-no because SA 4%, where can you find? Because in Singapore context, any bond that is above 4.5% is considered high yield, which is higher risk. So DBS bond, OCBC bond, the bank bonds, which is lower risk, will give you about 3 to 3.5% money. Okay, unless it's perpetual bond, which is higher risk, they will give you about 4 to 5, but it's already full. They will call back. So in a way, if you are looking at 4% for special account, no point, because special account give you 4%. This is a very good bond fund already. So OA, yes, you can take some risk. So that is depending on what kind of risk appetite that you are looking at. 2.5, maybe you can invest in a bond mixed asset, probably will give you about 4 to 5 or maybe 6%, depending on the market. Okay, if the market right now, probably you will only probably last 10 years that you have invested, probably now it's only back to about 2%, 3%. Okay, because market have gone down. So these are the things that you have to take the right, okay, up and down of the market.
Okay, thank you, Jonathan. Okay, from a question from Elisa, as a civil servant, can we withdraw CPF Life at 20? Oh, we can withdraw CPF Life at 62 years old. So should we defer to 65 or just start withdrawing at 62 years old? Margaret, you want to take this question?
Okay, sure. So for Alice, right? CPF Life actually starts at the age of 65. So depending on which tier of retirement scheme you have reached. So I think you're talking about withdrawing the excess after you have set aside the minimum sum. So for the excess, you can actually start withdrawing anytime after age 55. So I think this depends really on a person's financial circumstances. So if there's a need, then maybe you need to withdraw. If there's no need, of course, if there are alternative options, then maybe you can withdraw from your other assets such as cash, because without withdrawing from your CPF, depending on where the monies are from which account, right? It will still give you a higher interest. So be it 2.5, be it 4%, it is still attractive than the current low interest rate climate. So depending on your situation, yeah.
We have a question from from, let me see, this one I cannot really read. From Sally. Okay, if I am on an IP for private hospitals, is it possible to downgrade from private hospital integrated shield plan to government hospitals, a class ward, especially when it costs a lot more when I am in my 70s and 80s and I have to even pay cash for the premium? Jordan, you answer this question.
Okay, can you repeat again the questions?
Yeah, I think this one, okay, basically I think what Sally is asking is that, is it, if she's on an IP for private hospitals, is it possible to downgrade from private hospital integrated shield plan to government hospitals?
Okay, yes, you can. Okay, I work with a lot of clients whereby their shield plan premium has actually went up quite a lot. Okay, so they don't mind going to private, downgrade to a government hospital. From what I see, some of the questions they are saying that government hospital are not as good as private. Not really true, because my mom is through the government hospital. Okay, she's actually in the B1 one. Okay, so every time I bring her to visit the government hospital, their service are quite good. Okay, but of course, sometimes people may want to stay in private hospital, partly because they say that, oh, I got better specialists. Okay, I got better, equipment, but not true. When it comes to equipment, government hospital have the best equipment. Okay, in any kind of situations. Okay, so but of course, your private will definitely give you better service. Okay, so back to Sally question is that can she actually downgrade or not? I will say yes, but you go and look around. Is it comfortable? Are you comfortable with A-class government hospital? So here you got to go and find out. Okay, so if you are in the 70s, where is her? I can't see her question. Okay, she talked about.
Yeah, will it cost a lot more when she's in her 70s and 80s and even have to pay cash for the premium?
Okay, Sally, is all depending on, as I said, I try to maintain my clients' lifestyle. I got this client who is a principal, retired principal, and she every few years she will ask me, hey, the A-class one, she's actually on government hospital A-class one. And right now she's about 74 years old, and she's paying about near to $5,000 per year of premium. Okay, she do not take out the rider. It's just a basic below. So she's asking me whether she should downgrade or not. Then I said no. Partly because I already built about 80,000 per year of income for her, and this 5,000 I know she can afford. So it's about affordability. Don't look at the premium as a premium so high I should downgrade. No, look at the total asset that you have. Look at the lifestyle that you have. What kind of lifestyle you have, you got to match it. Okay, you may be having a very good lifestyle, living in London and all that, but when it comes to care, hospitalization care, you want the lower C class. Okay, that doesn't match. Okay, so you must make sure that you are living a lifestyle that matches. So I always try to maintain my client's lifestyle. If you are at this kind of lifestyle, you should take care of yourself when you are sick, especially. So don't look at the premium at this and then you say that it's too high, then I should downgrade. Okay, how comfortable you are is all depending on you yourself have to decide. Advisor can't decide for you because I do not know. Okay, when I say, oh yeah, you can downgrade to a government hospital from private. Then when you go to government one, you tell me that, oh no, I cannot take it because it wait too long. So you have to decide. But your affordability. Normally, for my client, that retired principal, I told her, no, you can afford it. You maintain as A-class government hospital. That's all.
Okay. We have a question from P. Kwan Go. Thanks for the question. If I have the money to pay for my outpatient clinic treatments, would you still opt to pay your treatment through your MediShield? Margaret, you want to answer this question?
I think the answer really depends. I think there's no right or no wrong, because CPF MediSave gives you an interest of 4%. So if you don't utilize it, your money will be accumulated at 4%. But then you cannot have accessibility to the monies like your bank account, right? You can only use it for medical bills, medical related costs, pay insurance premium. So if you don't want to use your cash, then you actually can use your MediSave money. So depending on what procedure, they always have limits that you need to check. You can't fund for everything, deduction from your CPF MediSave. So, but yeah, so if you want to use cash, then you don't touch it, it grows at interest. If you don't want to pay cash, then you can just use it. So I think there's no right, no wrong. So whatever unutilized your CPF MediSave monies, next time when you are no longer around, then it will be passed to your estate. So so depending, I think it depends on no right, no wrong. Yeah.
Okay, thank you, Margaret. We have one question for, I think we'll just take another maybe 3 to 4 questions. Okay, it's getting a bit late and there are a lot of questions. So, okay, from James, for cohorts that can choose between CPF Life and CPF RSS, which is better? I guess it depends on your assumption of your lifespan. I'm not sure if this is a question, but not sure if this is a correct scheme where you have monthly withdrawal till CPF RA runs out. Which is better? I guess it depends on your assumption of your lifespan. Is this a question? Any of the speakers you want to answer?
Can you repeat the questions again?
Okay, I try. For cohorts that can choose between CPF Life and CPF RS, which is better?
I know. The minimum sum. Okay, and then
I guess it depends on your assumption of which he's asking which one is better, basically.
Okay. Normally, I face these questions quite a lot of times. Partly is because I serve clients that are retire much earlier. Okay, so they will have the options of CPF Life or minimum sum. So a lot actually stay in the minimum sum whereby it will pay you a constant amount, okay, until you exhaust the amount in your CPF retirement account. CPF Life, you put it in, you buy CPF Life and then you pay the amount forever. So come to which one is better? Should you switch to CPF Life or not? Okay, so bear in mind, minimum sum will pay you a higher payout right now. If you switch to CPF Life, it will pay you a much lower amount each month. So here again, I got to ask you a question. How is your health? Okay. For people who are not too healthy, then I will say, okay, you go for maintain at the minimum sum. If you are very healthy, you know you are going to live very long, opt in to what? To CPF Life. So that is something that you can actually give some thought. Okay, so because if you are not very healthy and you know that this person, or let's say not very healthy, and know that they probably won't live beyond, let's say 90, okay, and now he is about 75. So now a minimum sum will probably exhaust in about 88, 89. So it's just nice. But you actually enjoy more money. The main thing is that you got to enjoy more money month per month. So if let's say this person is actually going to live, they're not very healthy, I can live beyond up to 100. So you will exhaust at roughly about 88 years old. Then from 88 to 100, then how? Because he's still very healthy. So opt into CPF Life, you get a lesser amount per month, but you will be able to support you throughout your lifetime until 100 and beyond. So that is something that you can actually give some thought. So sidetrack a bit. Up to those people who choose, what should I choose? My client always asks me, should I choose basic or should I choose standard? Standard will pay you more but have a lower bequest. Okay, but basic will pay you less but have a higher bequest. Bequest, that means when you die halfway before age 85, you got more money, leave it to your next of kin. So what to choose? So same here, I also look at it. At age 65, then you decide, you can actually decide which one, how is your health? Okay, how is your health? It's very important. If your health is actually very good, okay, if your health is actually very good, very healthy, okay, then I would say you go for the basic, you take more. If your health is actually not very good, you know that you probably will die earlier, okay, I mean probably, then you take the one with more bequest. Because if you know that you won't live beyond 85, maybe about 80, then you still got some more bequest pay out to your next of kin. Okay, more bequest will pay out to, but if you don't have any next of kin, you are single or you don't have children, then you just go for the standard. So these are something that you all can actually give some thought. Okay, that's all.
Okay, maybe another one or two more. Okay, there's a question for Frank. For shielding, there's very limited options of unit trust we can use under CPF SAIS. Can we use gold to shield?
No, only less riskier asset like bonds or fixed income. Yeah, not for gold. Gold is quite volatile.
Okay, thank you. Maybe one more question. With multiple streams, regarding to multiple streams, are there any recommendations or capital guaranteed investments offered by Phillip? I think any of our financial specialists can answer this question.
Yes, there are. Because Phillip, we represent a lot of unit trusts, a lot of insurance company, and also got our own managed account. So we represent about 12 insurance company, and if you are looking at capital guarantee, mostly will come from the insurance side. So you got to choose, very, very important is actually you got to choose the correct type of plan. Capital guarantee is one thing. Secondly is that you must choose a retirement plan that don't lock your money for let's say 20, 30 years that are immovable. You must choose some plans that that don't lock one. That means your money is always liquid. So that is something that you can actually give some thought on that.
Okay, thank you. Okay, I think that I'll take the last question. I also want to take a question. The last question, right, is someone asking, is there a recording for this session? So this one, I'll answer this question. Anyway, this webinar, we will also put it onto our PhillipCapital YouTube channel. And also you will be able to see it on our Phillip Wealth Advisory Facebook page. So if you would like to maybe, watch a recording of this session, you can check out the Facebook page. We'll probably have it up maybe next week. So yeah, that's the end of the Q&A section. Okay, give me a while. So, business banking. Okay, I would just want to reiterate again that we welcome you to connect with Phillip and also with any of our financial specialists tonight. They have answered so many of your questions. If you want to find out more or you have any other questions that were left unanswered today, you can feel free to reach out to them through these links. Yep. Okay, and do follow us. And last one, right? Before we end the session tonight, I just want to say that I would have also learned a lot and have been taking a lot of mental notes for myself and my own CPF. So at this juncture, I also want to welcome comments on what kind of topics do any of our audience wish to hear in our next Ask Me Anything series. Your input is very valuable to us, and we strongly believe in equipping our clients through education, so you can better plan and make informed financial decisions. Okay, so now I'll have our speakers wrap up by giving two or three takeaway points from their own experience planning for their own or their client CPF. Yeah, speakers, maybe start with Jonathan.
Hi. Okay, two takeaway over here for myself is actually build your SA up to the full retirement sum ASAP. Make sure that the amount in your SA compound at 4% until 55. The next one is do not keep a lot of money in your OA, okay, without touching it, okay, after 65. Because as I told you, okay, OA, when you do shielding, you got SA. So your SA, let's say you got 300,000, I got some client who OA got 500,000 there, and it will never be able to take up the OA. Why? Because if you want to touch your OA, you got to liquidate, or you got to withdraw all your SA first before you will be able to touch the OA. Okay, you got to zero out all your SA, which a lot of my clients will not zero out their SA. Okay, so the OA 500,000, as I said, you put there 20 years, 500,000 will go to 800,000, and you can never touch it, and that become not your money. So normally what I do is actually when I do shielding, I always tell my client, leave about 100,000 or 150,000 in your OA as emergency cash, and the rest of the money should be withdrawn out to do investment, whether is it in dividend portfolio or managed account or insurance retirement plan with capital guarantee. Bear in mind, okay, you have to do asset allocation. 50 or 60% of your money should be very safe. Okay, that's including your CPF SA and CPF Life, and the rest of the money you should actually take a bit of risk. Okay, ultimately then you can actually combine to get a reasonable returns. Okay, that's my sharing. Thank you.
Margaret, your key takeaway from on CPF?
I think everybody has CPF, so CPF is actually quite a significant part of a person's assets. So as you all can hear today, there's actually a lot of different financial instruments out there. And I think every financial instrument has their pros and cons. So I think it would be good if you all can discuss with a professional consultant and make a more informed decision for your hard-earned monies. Yeah, thank you.
Frank, let's finish it up with you. Yeah, your key takeaways.
Okay, key takeaways. In general, I would say protection form the foundation of financial planning before we move on to do any investment. Okay, in general, I'm not talking about specifically about CPF. Then when doing investment, do diversify your investment portfolio so that you will not lose out in a single investment. Yeah, that's all from me.
Okay, thank you. Okay, we have all right. I think we have come to the end of the session, and I would just like to thank our three remarkable speakers for their sharing, and also a big thank you to everyone who has stayed with us thus far. Do join us for our upcoming Ask Me Anything episode, International Women's Day special in March. So yeah, see you, and good night. Good night to everyone. Yeah. Night.
Good night. Thank you.
Thank you. Bye-bye.
Bye.